Hi, my name is Matthew Lewis and I'm a Director of Open Corp. Thank you very much for joining us for this webinar. Firstly, a quick update on the Open Access Fund. Since launching last month, we've had a lot of interest, and as a result, the Albion project was fully subscribed at close. So thank you very much for getting behind the fund, and we're glad that we're able to provide a product that meets your needs. Now, in relation to the webinar, we got some great feedback last time for the webinar for the Albion project. So today we're going to focus just on the Hawthorn East project. Previously, we'd also covered the Open Access Fund. So if you do want more information on the Open Access Fund, you'll have to watch the webinar that was provided previously, which covered how to get into the Open Access Fund and what exactly does that fund provide for you. So the Hawthorn East project is a very exciting project. A lot of our client base are located in Melbourne and have been asking us to secure a project in Melbourne. We've worked very hard to find this project and we secured it about 6 months ago. So it's great that we're now able to provide this opportunity for you to invest in. Now I'm going to be going through the content tonight in chapters, so you'll be able to come back and watch any additional content that you wanted to just touch up on at a later date. So you'll be able to click on the link to go back to that chapter. Now we're going to be looking at the acquisition strategy behind acquiring the project. We're also going to be looking at a number of the features of the project, and I'm going to be providing really high level but covering probably a little bit more detail in some areas, or broadening your understanding of the project from what you'll find in the PDF. So thank you again for joining us. I hope that you find this webinar interesting and the content helps you in making a decision about investing in the Hawthorn East project. Thanks.
For those of you that are joining us on one of our project launch webinars for the first time, you'll find that the structure of the webinar follows some of the main areas of the product disclosure statement. The importance of that is that we need to make sure that you're well and truly understanding the content of the product disclosure statement so that you can make an informed decision about whether or not you wish to invest in the project. Now, before I get into the webinar itself, and you'll find that a recurring theme through the product disclosure statement when we look at the market and we look at our acquisition strategy, which I'll talk about both of those things tonight. One of the key themes is the focus on the inner east suburbs of Melbourne. And recently, the REIV published their March quarter median house price results, and 15 of the 20 most expensive suburbs within Victoria were found to be located in Melbourne's inner eastern suburbs. And interestingly, of those 15, 8 of them are in Boroondara, which is obviously where the Hawthorn East project is located. And that was obviously a key thing for us when we're searching for new sites. To seek out areas that we think are going to perform well. And as I said, there'll be a little bit more information about that shortly. So the structure, we've obviously already welcomed you to the webinar. I'm going to be talking about the Hawthorn East project, and I'll go through our acquisition strategy, the project overview, basically the summary of the benefits that you'll see in the PDS as well. Looking at the sales and marketing strategy, what's our strategy for realising the revenue on this project? What's our gearing? Again, it's very important in a product disclosure statement that we're clear on how much we're borrowing and when we'll be borrowing money. And it's obviously an important factor of Open Corp's strategy as well to buy property without any debt when we acquire the land. Also talk about a few of the risks. Obviously, it's not an exhaustive list of risks that I can go through in this webinar, but again, I'll refer you to the sections in the product disclosure statement that you can find the other risks or a list of other risks that are important to understand before making an investment in this project or this type of project. And then I'll talk about the returns. Obviously, returns are why we all invest, but it's important for us all to understand the strategy behind the business activities as well as the risks associated with that type of investment. Finally, I'll cover off how to invest in the project. And if you're already a member of the Open Access Fund, you'll find that it's extremely easy to submit an application for the Hawthorn East project. Now, I am required to go through a disclaimer, so I'm going to read the disclaimer word for word. It may be a little bit boring, but it is important that you do understand, I suppose, the limits of any statements that we make or recommendations that we make. Now, the issue of units in the Open Access Fund is Open Corporation Funds Management Limited. We're often referred to as a responsible entity, we, us, our, or even Open Corp. We do hold an Australian Financial Services licence, and as I noted, we are the responsible entity of the fund. Neither Open Corp nor any of our directors or associates guarantees the performance or the success of the offer or the project, the repayment of capital or any particular rate of capital or income return. We're not authorised to give personal financial product advice. We are authorised to provide you with general advice, meaning that we can talk till the cows come home about the project itself and about investing in the project, but we can't tell you whether it's right for you. So the product disclosure statement contains important information, but it doesn't take into account your investment objectives, financial situation or particular needs. Therefore, before you invest, you should read the PDS and any associated supplementary PDSs or website updates, and obviously attend this webinar. You should read and understand all of those various sources of material and consider whether you need to get your own independent financial advice or taxation advice before you make a decision to invest in the fund. Any mention of our past performance is not an indication of future returns in this fund. All projects are different, they carry with them different risks, selling in different markets, perhaps different types of product. So past returns may be used as a guide to understand whether Open Corp is suitably qualified to manage a project like this, but it doesn't indicate whether or not this project itself will provide an exceptional return or not. Thank you for bearing with me through that. Okay, so the Hawthorn East project strategy or acquisition strategy. Those of you that have invested with Open Corp before would be familiar with our MAP approach to finding investments. That means market, area, property. We look at the market first. So in the case of Australian property, we look at which capital city we want to be buying in. Once we've selected a capital city, we then start to focus in on an area or suburb. I've already talked before about the inner eastern suburbs being a very heavy focus for Open Corp, and obviously why we secured this property in Hawthorn East. And then once we have honed in on an area, and we often get very involved in negotiating or investigating particular acquisition opportunities, negotiating to buy them before we secure one that meets our needs. So why Melbourne out of the 4 capital cities? And I'm sure that everybody has followed the media and talk of the very heated markets in Sydney and Melbourne, obviously Sydney being a little bit ahead of Melbourne in terms of price growth over the last few years. What's not often spoken of when looking at the heat in the market or the activity within a market are the key drivers of that market. And one of the things that's really supported Melbourne's property market over the last couple of years has been the exceptionally strong population growth. Victoria is Australia's fastest growing state at the moment, and it's poised to overtake Sydney in about the next 45 years. So that's assuming that we continue to exceed Sydney's annual population growth. And obviously when your city is growing by 100,000 persons per year, you need to provide quite a lot of housing stock to meet that supply. So one of the reasons why we've had such a strong performing market over the last couple of years is that, as we know, when demand exceeds supply, prices go up, and there is a lot of demand from new residents and our growing population. which puts pressure on the price of housing and accommodation, but also results in an increase in building activity, and that's driving the Victorian economy at the moment as well, and is expected to continue to do so in the years to come. Now, talk briefly about demand factors there, the population growth, but supply factors are also extremely important. And while you would expect that as our population is growing quite quickly, there would be efforts to increase supply, and it's certainly a state government and federal government objective to increase the amount of supply and particularly focus new supply around existing infrastructure, meaning city or CBD areas where there's major activity nodes with train stations and retail and shopping and restaurants and so on, universities as well. But surprisingly, a number of Victoria's city councils have actually started to restrict the opportunities for new development. So you can see in this map here, there's a radius of about 10 kilometres around the Melbourne CBD. And if you look at the areas in the eastern suburbs, you can see that Yarra, Boroondara, Stonington, Glen Eira, Port Phillip pretty much make up that full inner eastern ring of council areas, as well as Melbourne City Council itself. But each of those 6 council areas have introduced new policies in the last 24 months. And those policies introduced new zones, or a new zone, which is called the Neighbourhood Residential Zone. So they rezoned large proportions of land that was previously Residential A. Residential A is the zone that was the predominant zone for low to medium density housing. So that was subdividing a 800 square metre block into 3 or 4 townhouses on around 200 square metres each, or taking a 1,500 square metre block around good infrastructure and developing that into 23 to 25 apartments. Now, the neighbourhood residential zone actually limits the lot size to a minimum of 500 square metres. So in Boroondara, for instance, a apartment site that Open Corp previously secured in Camberwell that was suitable for about 24 apartments prior to the zoning, after the zoning would be sufficient for only 2 townhouses. So that's a huge drop in potential supply, going from 24 apartments down to two townhouses. Now, if you look at that across all 6 of those areas, and Melbourne City Council hasn't necessarily rezoned its land into neighbourhood residential zone, but they've been tightening up the planning schemes to reduce heights of buildings through the CBD. And there was a recent announcement in the last 2 weeks of a new initiative to reduce the height of all new buildings in the CBD and limit the height of those buildings. So that obviously has a flow-on effect as well when they're limiting new supply in the CBD and all of the surrounding areas. So despite this high population growth, our city councils, particularly in the affluent suburbs or affluent suburban areas, are really fighting back against the state and federal government's policies of trying to increase density around CBDs, and they're actually going the other way. They're trying to reduce or limit new medium density housing in these areas. So if we now go to just having a look at Boroondara, and as I said earlier, 8 of the top 20 most expensive suburbs in Victoria are in Boroondara, but 4 of the top 5 suburbs in Vic are in Boroondara. The only one that's not in Boroondara in the top 5 is Toorak, and it's actually about 3 kilometres away from the border of Boroondara. So it's a very, very affluent area. What we know about property is that that through these affluent areas, it's not just supply and demand that pushes up the prices. It's also old money. So families that are quite wealthy have probably been living there for 30, 40 years, raised kids who are now young adults in the area as well, and they've got a lot of money behind their family. What we also know is statistically, people don't like to move more than 7 kilometres from where they were previously living. And the reason for this is that you develop your support network, you've got your family, friends, perhaps access to your job, and connections with sporting clubs and whatnot. So people tend to try to stay within a reasonably close vicinity, and as I said, statistically it's about 7 kilometres for 90% of people. So if you're looking at an area that we know that there's lots of wealth, there's a shortage of new supply coming through, then these young adults that have been growing up in Boroondara and the surrounding council areas that want to now get into the property market, finding it very difficult to get in buying established housing. And the reason for that is out to about Warrigal Road, which I'll try to identify here. So Warrigal Road is the border of Boroondara. The median house price for anything closer than Warrigal Road, and that's about 16 k's from the city, anything closer than that, the median house price is about $1.2 to $1.3 million. So that's the entry price for an established house in that area. So obviously for a first home buyer, that's a very, very high bar to cross. So being able to provide affordable housing product is absolutely critical to servicing the needs of the first home buyer market through this area. We also know that a lot of the people in these suburbs are ageing. They're on big properties and they're difficult to maintain. So we're seeing a growing trend of people that are downsizing, selling their larger property, wanting to move into an apartment that's close to amenity, that is a lot easier for them to maintain. They don't have to worry about the gardens, and they still have access to all of the things that they've grown accustomed to. We're even seeing people moving closer to the city as well from other areas, selling up their bigger property in the sort of middle to outer eastern suburbs and moving closer to the city once their kids have moved out of their home. Now this map here shows the extent of neighbourhood residential zone in Boroondara. So you can see that predominantly the entire council area is neighbourhood residential zone. Now there's a few small nodes of this blue, which are areas where further development is suitable for townhouse development. So the minimum lot size isn't 500 square metres in these areas, it's slightly less than that, and development is permitted up to about 3 stories. But still, that's not providing any great volume of housing, and keeping in mind that a townhouse in this area that I'm highlighting at the moment, the large blue area, which is in Camberwell, the entry-level townhouse there for a 3-bed townhouse is over $1 million. It's about $1.1 million to get into the entry level. So again, that the blue infill housing is not going to be satisfying the need for the entry-level first home buyer, and it's certainly not meeting the needs for the downsizers either. Now you can see some smaller areas of yellow, and there's some pink through here, and a little bit of mixed use zone that is situated around Hawthorn East, which I'm just highlighting at the moment. And that's really the limits of where new development will occur, and particularly development over 3 stories. So it's not a lot, considering that 2 years ago the entire area just about of Boroondara was residential A, and that could be developed into could be developed up to 16 metres in height, which is sufficient for 3 or 4 stories of apartments, provided you could demonstrate a solid case for your development being close to amenity. So the supply opportunities here in Boroondara have been pulled back significantly. The same goes for Stonington, which is situated adjacent to Boroondara, Same goes for Glen Ira, which is on the other side of Stonington. So huge constraints on supply in Melbourne's inner eastern suburbs, and one of the contributing factors to Melbourne's inner east being the highest price real estate in the state by far. So that was, I suppose, a lot of the background on why we've been focusing on the inner eastern suburbs of Melbourne. We believe that where you can find a site that has the potential to be, or has the correct zoning for further development, those sites are like gold because there's fewer and fewer of them available now, and as over the next couple of years there'll be a lot less new housing stock or new apartment stock coming onto the market through Burundara. So the opportunity to acquire a site in a mixed-use zone which is suitable for apartments up to 6 levels we think is fantastic, and obviously the area itself is a blue chip area. Hawthorn East median house price is 1.7 million. So again, being able to provide an affordable product is really positioning our acquisition well to succeed in the future. Now onto the project overview. So the project itself is 70 apartments. We've got a very advanced planning design. Now we appointed Rothy Lohmann Architects, who were the architect on the nearby Brass House project, which has sold exceptionally well. And we've assembled a good quality project team, obviously led with Rothy Lohmann Architects, with a view to submitting a conforming design to council. That design's very well advanced. However, we cannot lodge for a planning application until we've closed this offer. The reason for that is that if we submit a planning application prior to issuing units in the fund, there's potential for stamp duty to be incurred as a result of the development activity occurring before the issue of equity. So we've progressed our planning design. We're ready to lodge imminently, and obviously we've put it on hold pending the completion of this offer and the issue of units in the fund. We've had 2 builders quote the construction work, and we handpicked the builders because they've completed projects of a similar nature nearby and to a standard that we think is commensurate to the type of product that we want to be delivering and selling on the market. Now we've got a mixture of 1 and 2 bedroom apartments. Now the floor plan is still moving around slightly just in terms of the product mix and getting a few extra bathrooms in here or there. So when we do lodge in June for our planning application, we may say that there's a slightly different mix of 1 and 2 bedrooms, but we've really targeted a mix that gives us the most flexibility. Now I've mentioned that there's a big downsizer market that's not only within or living within Burundara, but also migrating from some of the outer suburbs of Melbourne into this very highly sought after area. So being able to provide flexibility for a 3-bedroom product is really critical to attracting that market. Now, downsizers don't necessarily need 3 bedrooms because generally it's a couple with no kids. However, they do like to have the extra space for storage, for guests. So it's probably the most highly sought after product for downsizers. Now, the tricky thing is obviously in designing a project that you don't want to overcommit to the larger apartments because they are more expensive, and you want to make sure that you've got the maximum flexibility of selling 1s or 2s or 3 beds to attract the broadest segment or the broadest range of the market. And I'll talk a little bit more about sales and marketing in a moment. The investment timeline for the project is around 2.5 years. So that gives us time to obviously lodge our planning application after we issue the units in the fund, to then get our planning permit later this year, commence selling, and be in a position to commence construction around June of 2017 with about a 16-month, 15 to 16-month construction period to take through to get settlements. Now Hawthorn East, I've already shown you the map of Burundara, and this is just a bit of a map that shows the location of the project relative to the city and some of the key infrastructure, being the Monash Freeway, which is this white line that runs through here, and obviously the train line, this is the Glen Waverley train line. We're also relatively close to the Camberwell train line as well, and the Pakenham line, which runs down here. So very well serviced with public transport. There's a lot of bus stops around as well, connecting to the train network. So the site itself, the green box obviously shows the volumetric area of our development. You can see that it's reasonably well elevated, and you can see the city off to the which is to the west of the site. You can also see here some of the key features of the area in terms of amenity. You've got Gardeners Creek Trail, which has got a huge bike network. It runs all the way into the city and all the way out to the Dandenongs, about 30 kilometres to the east of here. Most of that is now able to be covered without crossing roads, so they've got tunnels under roads or bridges, so it's a very heavily trafficked bicycle network and running path there, and obviously you've got the creek, and that connects with the Yarra River about 5 kilometres from the site. We've also got some of Melbourne's most prestigious schools, St Kevin's College, Scotch College as well, just a couple of kilometres further west of the site or closer to the CBD, and not to mention Bialik College, which is one of the premium Jewish schools in the country. There's also very, very good public schools in the area as well, so very well serviced for schooling. And we've got Swinburne University about 3 kilometres away in the centre of Hawthorn. There's also a campus of Melbourne University about 1 kilometre from the site. So again, from a university attracting students, the site's really well positioned, and you can see from the image here that the upper levels have got really good opportunities for views to the CBD, and picking up some of that, I suppose, hilly outlook and undulation that you see across Melbourne's eastern suburbs. Just over here to the west on the other side of the freeway, you can see that that's the suburb of Toorak there, so you can see how close we are to Toorak, and obviously being right in the mix of Melbourne's premier real estate hotspots. In terms of design, Rothy Lohmann have, as I said, progressed the design quite a long way. So we've locked in with a mixture of 2 and 1 bedroom apartments, and with flexibility for 3 beds. So I'll show you the 3-bed option shortly. Now we've set it up as a bit of a T design, which is great for maximising the efficiency on a square site like this, and it also provides for strong setbacks from the side boundaries. So we have a laneway to the north of the site, which separates us, so this is the laneway up here, and that laneway separates us from some of the commercial buildings to the north, which are about 2 stories, but it gives us good setbacks and obviously the opportunity to really open up that northern area with living areas and balconies to capture some views. Obviously the curves as well, just providing a bit of form to make the building more interesting and more attractive, and The upper level, I suppose, another key feature of this design, the upper level has a communal media room and communal outdoor space, which we would imagine is going to include barbecue area, some seating, some tables, and yeah, obviously give the residents of the development an opportunity to host friends and have small gatherings there, which is obviously a feature that's not evident or not available in all projects in the area. So just in terms of the facade and building form, and again, the facade's still a little bit of a work in progress as we tweak it and we do cost scenarios on the materials that have been proposed and make sure that we achieve the most efficient design. This is looking east up Toorak Road. This is looking north at the building from across the road, so you can see that we've got some curves that have been picked up in the form of the building facade as well, and bit of screening there and different materials to provide a bit of interest to the building itself. So on to the sales and marketing. Now this chart shows a set of competitors against our subject site. It's also available within the Part B PDS, so you're not expected to memorise this from the webinar. You'll be able to refer to the Part B PDS to see all of this detail. Now the closest competitor is Brass House, which is located about 30 metres up the road from our site. Was also designed by Rothy Lohmann Architects. Now as you can see, they started with 48 apartments and they're now down to 16. So they've hit their pre-sale target and they're preparing for construction to commence. They have obviously only a small number of units left. Now their stock was actually quite small for this market. Their one bidder started at 48 square metres and were priced from 430,000. So obviously comparable to our project, our smallest stock is about 4 square metres bigger and obviously about a $40,000 price difference, which is just under $10,000 or roughly $10,000 a square metre difference in those two prices. Now that did sell very well, and one of the great things about using their architect is obviously that we were able to pick up some of their learnings and had the feedback from the developer as to which of their stocks sold extremely well, and we were able to take that into consideration in designing our building. The Hawthorn Club, about 3 kilometres away from our site in central Hawthorn, total of 64 apartments, only 9 remaining. They've obviously met their pre-sale target as well, and again their one bidders started from just under 50 square metres. They're priced about $50,000 or $45,000 above ours, despite a 3 square metre difference. So on a like-for-like basis, they obviously have a much higher rate per square metre than we're forecasting for our project. Similarly with the 2 bidders, starting at about 69 square metres and pricing around $70,000 above our entry point. So again, from those 2 comparables, we're very well priced on the market. You can see also when you look at the Hawthorn Club, the 3 bidders actually achieved much higher than $10,000 per square metre. They didn't have a lot of 3-bed stock, but what they did have sold very well. Solstice, again in Hawthorn East, like Brass House and like our site, started with 106 apartments. We don't have the detail on exactly how many there are left, but we have confirmed that they've achieved their pre-sale target. And again, looking at their prices, they're tracking at roughly about $10,000 per square metre. Middle Burke in Camberwell is under construction. Started with 50 apartments down to 8, just under $10,000 per square metre. I suppose the only variance is when you get up to the 3 bidders, they're well and truly over $10,000 per square metre. So you can see in a number of these projects, Hawthorn Club and Middle Burke, that 3-bedroom apartments are getting a premium. And then going over to High and Spring in Malvern. So Malvern's obviously the suburb just to the south of Hawthorn East. It's located in Stonington but borders Boroondara. They've achieved their pre-sales, started with 100 down to 22. Their smaller stock, they were getting 10,000 a square metre. For their two-bedders, they're getting above 10,000 a square metre. And for their three-bedders, they're getting well and truly above $3,000 per square metre. So, sorry, $10,000 per square metre. So again, you can see that as the stock gets bigger, there's generally a bit of a premiums getting paid in this area. One of the other great things is that from this table you can see that despite starting with over 300 apartments, it's around 350, we only have about 50 of that left on the market right now. Now our project's going to come to market in about 6 months, so most of this stock, if not all of it, I'd expect would have sold. There'll be new competitors coming onto the market obviously over the next 6 months, as some other sites like ours do get planning permits. But the size of new competitors is obviously limited because there's not a lot of, there aren't many large sites available in Borondara or the eastern areas of Stonington Council. Now these projects also went to market about 6 months ago, and we're going to market in 6 months. So there'll be a year's difference from when they started selling to when we start selling. Obviously with their success, sales prices may move over the next 6 months as they run out of stock and as new projects come to market and perhaps seek a higher price point. That being said, our pricing is set at about $9,500 per square metre. So you can see relative to Hawthorn and Camberwell, where in Hawthorn East we'll be seeking, I suppose, or expecting a bit of a discount or pricing in a bit of a discount to those markets. Now, obviously, our goal is to achieve price parity with those projects, but from a feasibility perspective, we always like to be conservative and go in with numbers that we know that we're highly confident of achieving. So if we do see some price escalation between now and when we start marketing the project, well, that's a benefit or a bonus for the investors that do participate in the project. We never factor in price escalation, or we very rarely would factor in price escalation, particularly not on a single stage project. Obviously, as projects become multi-stage, then at times it's necessary to look at some price growth, but in this case, there's no escalation factored into our feasibility. Now, as you can see, I haven't put in any three-bedders. That's obviously because we don't have a fixed three-bedroom layout. We've got a number of different layouts that we can use to give flexibility, and obviously knowing that the market is not necessarily saturated with people seeking three beds, but those that are in the market looking for a three-bedroom apartment are prepared to pay a premium, we wanted to have that flexibility without committing ourselves to having to provide a set number of three-bedroom apartments. Now you can see here that there are a couple of different options, and there's actually more than this, but just for illustration purposes, thought I'd show you how we would set out some of the three-bedroom layouts. So we'll be having marketing floor plans done up for a couple of different three-bedroom layouts. So buyers have a fair bit of choice in how they could structure a three-bedroom apartment. Now, the red option is 2 one-beds joined together. These would equate to about 106 square metres living area. So that would make it, I suppose, a reasonably attractive size in terms of a three-bedroom apartment. It's certainly not on the small side, but it's not as generous as some of the apartments, such as High and Spring, for instance, have fairly large three-bedroom apartments. It also has a 16 square metre terrace. Now, the blue option would be combining a two-bedroom with a one-bedroom apartment, and that provides a 120 square metre apartment there. So again, if we work on the basis that the buyer was paying about $9,500 a square metre, then the blue apartment's going to come in at about 1.14 million, while the red apartment would be about just a touch over 1 million. So there's about $140,000 difference there in going from 106 to the 120 square metre apartment. Now again, if a prospective purchaser decided they wanted to put two-bedroom apartments together, then they could actually move the apartment size up to about 130 to 140 square metres. So that's getting quite on the large side for a 3-bedroom apartment, but again, providing that flexibility for the downsizer and the owner-occupier is a key to our strategy. It opens the doors obviously for getting more inquiry, and while some of the purchasers may not necessarily proceed with buying a 3-bedroom, having the opportunity for a 3-bedroom when there's not a lot of them in the market does start to pick up a few extra buyers there. So just another thing I suppose to note about downsizers, which I've obviously talked a little bit about today. Now in the market at the moment, for a downsizer to buy a property, it's a lot easier for people who are downsizing because they've already got equity in their home. So generally they're selling a large family home to buy a new product. So often they're the most flexible on price, and they'll pay extra to get what they want. Obviously at the first home buyer bracket, if you're on the outer suburbs, then generally you're very constrained in deposit for a first home buyer. In areas like this in Hawthorn East, around Boroondara and Stonington, the first home buyers are often being assisted with equity from their parents. So again, that's one of the critical things that attracts us to this area, because it gives a little bit more depth to that market and makes it a little bit less price sensitive at that entry point. And as we know, interest rates are quite low at the moment. So for a first home buyer that may be white collar worker working in the city, wanting to be close to CBD access, public transport or the freeway, we're certainly in the right spot. But for that type of buyer, servicing a loan is not all that difficult right now. The bigger issue for many buyers is getting the deposit and saving up for their purchase. So speaking of debt, we'll I guess move on to the project gearing. And one of the key tenets of OpenCorp's acquisition strategy is to buy land without debt. Now the key, or the reason that we like to buy without debt, is that it really gives us a lot of flexibility. So if we own the land outright, and this comes down to risk management, if we own the land outright and there is a delay in any factor of the development program prior to kicking off, we don't have any fixed milestones that we need to meet for a bank. Now, if a developer was to acquire a site and they could gear the purchase to 30%, let's say, then the bank that's lending them that money is going to want to see activity on their site in a very finite period. So if they were delayed in kicking off, then they obviously have that risk that the bank may not want to extend the loan, which means they then need to go and refinance with another lender, or if they can't source new finance, they need to sell their site. So again, from a risk management perspective, we are absolutely critical of gearing strategies, and we buy with equity without debt to settle the land. Now, as we start to progress through the development program and we get to a point where we start marketing and we start selling the apartments, and in this case, in the case of apartments, generally when you get a pre-sale, the agent's commission is payable 50% on the unconditional sale and 50% on settlement of the completed product. So as you start to get pre-sales, obviously there are sales commissions that become payable. So we do start to take debt on as we start to market and we get our pre-sales. And we see that as an effective strategy though, because if you don't get the pre-sales, you don't pay the commissions and you don't draw down on the debt. So we secure a debt finance in that pre-sale phase, and we start to draw down on the facility as we get the pre-sales, and then once we hit our pre-sale target, then the construction facility kicks in. And in this case, we're looking at a peak or a total debt of a touch over 23 million, which brings our LVR to just under 62%. Now, that's certainly not an aggressive LVR, but it is important to understand that over the last 12 months, the appetite for lending with Australia's major banks has really pulled back, and the reason for that is that banks are trying to, I suppose, be a little bit pickier about where they're lending their money. They have been instructed by APRA to increase their capitalisation rates, meaning they need to hold more cash on their own balance sheets, which limits a little bit the amount they wish to lend for commercial finance. Now, we've never had any problem securing finance for any of our projects. 12 months ago, we would be securing loans up to about 65% gearing with a bank. Now the banks are capping out at about 60%. So doesn't mean that there's a problem getting finance above 60%. It just means that it becomes a little bit more expensive. So in this case, we'll be sourcing a senior debt facility from a major bank with an LVR of up to 60%. And the extra bit over that we'll fund through a second mortgage. So we've received an offer for that second mortgage and a term sheet or indicative term sheet for the senior debt piece, which will be tendered once we obviously get to the construction debt phase, subject to getting a planning permit. But as I said, securing the finance is not the tricky part. It's more so that the cost of that finance is higher today than it was perhaps 12 months ago. Now, we factor all of that into our financial modelling, so the returns that we forecast for this project and that are included in our product disclosure statement have already taken into account that higher cost of funding. Now, if over the next 6 months the bank's appetite increases and they start to lift their LVRs again, then that cost of funding will come down. Conversely, if the bank's appetite tightens a little bit more, then we may end up having a slightly larger second mortgage, which means the cost of finance will go up a little bit. But generally speaking, the cost of financing a project like this does not make up a large proportion of the overall cost of the project. In fact, it would be less than 5%. So if you're seeing interest rates go up by 1 or 2% on average across the project, it's not a significant change to the project financials. Certainly not as much as obviously a construction cost increase of 1%, and would have a greater impact than interest rates going up by 1%. So the project risks. Now, it is important for everybody to understand the risks of any investment because it's one thing for us to forecast a strong return on an investment like this, but if you don't understand the risks, then obviously the return is rather meaningless. Our goal in acquiring any project and managing a project is to achieve a premium for obviously taking development risk, but to put processes in place to mitigate those risks as much as possible. So we get a premium return without the premium risk. But there are still risks, and we certainly can't eradicate all risks through the way we purchase the site or the way we manage it. So we are going to be exposed to some risk. Now, first and foremost is the planning risk. We've obviously done significant analysis and due diligence prior to committing to the project. We've put together a project team that are very experienced, and the architect has recently gotten approval for an adjoining project at Brass House. We asked them to design our project in accordance with the same metrics that they used for the Brass House development to ensure that we're maximising the chance of getting an approval. Our town planner has indicated that our design is in accordance with the planning scheme. So in many regards, we tick all of the boxes that are necessary to get a planning permit, and we're very confident of getting one. Nonetheless, there are risks to the planning process, which obviously there may be an objector. There's not a lot of residential dwellings around us, obviously being in a commercial mixed-use zone. We're designing something that's in accordance with the planning scheme, so the opportunities for objections are rather minimal, but that is a risk that still exists. And obviously the timing risk. So we've forecast to have an approval by December, which is reasonable, and which our consultants support that time frame. But again, there can be things that occur during the planning process, additional reports that council may request, to demonstrate serviceability or whatnot, and that can increase the time frame to get an approval. Now, our development program assumes sales commencing around December as well, with marketing just before that. So the marketing and sales are not necessarily dependent on the development approval. So a delay of a month or two in the development approval won't impact our construction commencement date. A delay in planning approval beyond the 1 or 2 months is going to have an obvious impact on when we commence construction of the project, and that obviously flows through to when we complete the project, so the timing of when we return capital. Also through the planning process, while we're confident of getting an approval, sometimes there can be conditions imposed that you might not have forecast on application. We've assumed that we're providing all external services, and we have reports from qualified consultants to tell us where those services are and what type of upgrades we need to do, if any. But again, there's a risk that council may impose a more onerous condition than what we had anticipated there. And obviously that any conditions they impose need to be within reason. Yeah, it's obviously something that everybody needs to understand in that planning process. Construction risks. So we've obviously made a construction allowance, which is based on 2 independent building quotes, and we've also included a contingency of 5% on top of the construction cost. Now that's separate to the 5% contingency we have on all other soft costs or variable costs like professional fees or statutory charges and marketing. But obviously construction is the biggest single cost item in a project like this, followed by the purchase of the land. So purchase of the land, the price isn't going to change, but construction prices can change, which may be the result of customers or purchasers requesting changes to their finishes or their layouts. Could be also as a result of conditions imposed by council, or it could be the result of, I suppose, site conditions once the builder starts to excavate the site. Now also, while we've tendered the design in order to get the building quotes, we haven't entered into a contract. So again, over the next 6 months, as we go through the planning process, the builder's costs may change. We've included some sensitivity analysis in the product disclosure statement. So you can look at the sensitivity analysis to understand the impacts of cost increases on the financial returns of the project. So again, one of the important things to understand as well is that in the scenarios where we've modelled an increase in cost up to the limits that we've modelled so far, the project is still quite profitable. So there is some resilience to cost increases. Impacts of cost increases also flow into the amount of debt that you take on. If costs go up, then obviously we need to increase the debt facility that we secure. Finance risk, I've already mentioned we don't take debt on the land when we acquire it. We buy unencumbered, which is absolutely critical to managing financial risk there. And we have target borrowings of 61%. And as I said, while we are forecasting a second mortgage as it exceeds the senior bank's target of 60% LVR, it's still not an aggressive LVR in terms of historical averages and particularly, I suppose, market trends. Most developers certainly push close to that 65%. Some go over it. We certainly don't. But yeah, we're very comfortable around that 60-61% mark where we've modelled this project, and we're going to be pre-selling enough of our product on unconditional contracts with full 10% deposits to cover all of the debt before we start construction. So if we know that obviously at $23 odd million peak debt, if we've sold $23 million worth of stock, then we know before we even start construction that as soon as construction's finished, we're going to be able to clear off all of that debt. We'd also be confident that in achieving those pre-sales, we've established that there's a market for our product and that we should be able to continue selling through the construction period in the hope of clearing out the balance of that stock Sometimes once we start construction, we do like to creep our prices up to try and get a premium for them, as the stock obviously, stock levels diminish. But we generally try to factor in a couple of different pushes through that construction period to get the rest of our stock sold, so that it all settles in one line as construction is completed. Nonetheless, as I mentioned, there is risk in terms of cost of financing and making sure that the project meets different lenders' criteria to ensure that we secure the finance when we need to take it on. There are a range of other risks associated with a development like this. Some are also market-driven risks, more so than specific project risk. Those risks are identified in Section 7 and Section 19 of the Part BDS. So again, I'd recommend that you familiarise yourself with those sections of the PDS. So the project returns, obviously the reason why we all invest. Now, we're obviously going through and raising around $7.4 million for this project. Now, the project itself is a wholesale fund, or being developed by a wholesale fund that OpenCorp has established, with the Open Access Fund Hawthorn East unit holders acquiring an interest in that wholesale fund. So depending on the level of capital raising and interest from members of the Open Access Fund, that involvement in the project could range from $3 million up to 7.4. So if we raise $3 million, the lower end of the target for the retail, this retail offer, then there would obviously be $4.4 million taken up in the wholesale fund by wholesale investors. Now, obviously, if we raise $6.5 or $7 million through this offer for the Open Access Fund members, then the wholesale investors will only be offered $400,000 to $1 million worth of units in the wholesale fund. That offer is obviously open at the same time as the retail fund, and we'll close them both concurrently. So obviously we have a preference for giving our retail investors the opportunity to invest in that project. We have a number of commitments already coming through from wholesale investors, but we'd obviously like to see the retail fund members given the opportunity to invest in this project. Obviously, you subscribe at a price of $1 in May 2016, and in October 2018, when the project's concluded, we'll be returning $1.50 approximately. So that $1.50 is obviously made up of the initial investment. There'll be some tax taken out of the profits, but the total amount is obviously going to be $1.50 per unit. So if you invest $1 in 2.5 years, you'll get, if you invest $10,000 in 2.5 years, you'll get $15,000 back. And obviously a portion of that $15,000 will be taken out as tax. Now that equates to an annualised return of 18.43%. So that's at the target retail offer of $4.35 million. If the retail subscription is higher than $4.35 million, that IRR actually improves. And the reason for that is that the cost of compliance for managing the retail fund is a fixed cost per annum. So the more investors we have in the retail fund, the less each investor pays towards those compliance costs. So obviously the returns go up marginally. So the IRR, which you'll see on the left of that table, the internal rate of return, that's just the equivalent annualised return that you would need to get on your money to achieve the same total return in the same period. Now, to invest in the project. As I said, investing in the Hawthorn project is extremely easy if you're a member of the Open Access Fund. If you're not a member of the Open Access Fund and you're watching this webinar, then you will also need to read the Part A PDS and apply to become a member of the Open Access Fund. So you'll apply for units or for cash units in the Open Access Fund. And once you hold those cash units and you're a member of the fund, then you can apply to transfer or redeem some of your cash units and acquire Hawthorn East project units. Now, the Part B PDS, section 27, has the application form, and you'll see there's actually only 2 fields for you to complete. One of them is the investor identification number. So when you become a member of the Open Access Fund, you will have been given a unit certificate, and that unit certificate will include an investor identification number. That's important to make sure that you have that on file, because that's the number you need to include whenever you're applying to become a member of a new project, or if you're applying to increase your investment in the Access Fund. There's also a second box for the amount that you wish to invest in this project. So if your investor identification 001 and you wish to invest $10,000, then you would obviously just put 001 and $10,000, and you would then need to sign the application form and submit that. We don't need to see any identification. There's no additional paperwork that's required. It's literally just the application form with those 2 boxes filled in, and with your signature. The application obviously must be in by the offer closing date as well. And if you wish to acquire more units in this project than you hold in cash units in the Access Fund, you can apply to increase your holding in the Access Fund. There is a form that's available from our office that you can complete. Again, you'll just put in your identification number, the extra amount that you wish to invest. When you submit that, then you'll obviously have to transfer to the subscription account the extra funds that you're investing. But obviously once your funds are held in cash units, you no longer need to undertake any bank transfers. As we process your application to roll into the project class, then we redeem your cash units and automatically move you into the project. So timelines for investors in the project. The offer is closing on the 17th of May at this stage, but the Open Access Fund will obviously remain open for new investment at all times. The pre-sales commence later this year, so marketing commences around August, selling commences around December. We're forecasting around the same time that we get our planning application or planning permit, and we'd be in a position to commence construction in June. So typically for a project where we need to get about 41 pre-sales, we would expect about 3 to 4 months of selling. In this case, obviously we'd be selling over January and February, or December and January into February, which can be slower months. So we've allowed about 6 months to achieve our pre-sales here, and that's after also doing a marketing campaign leading up to our sales launch to build our database and build a bit of a pent-up demand before we start signing contracts to sell. And obviously we've got completion in October 2018. So as I said, that's about 16 months that we've allowed for the construction period. Now, obviously I'd like to thank you for your time in joining us for this webinar. In concluding, one of the questions that we often get in relation to the project and offer is what other projects we have coming up. So obviously we've been working on the Hawthorn East project since we acquired it in December. So it's taken about 4 months to get into a position to release this PDS. Hot on the heels of the Albion project, which we launched obviously in coinciding with the launch of the Open Access Fund itself. And we secured the Albion project in September of last year. So these first 2 projects coming through the Open Access Fund, we'd really been working on for about six months, and wanted to make sure that we had a couple of projects to meet the pent-up demand from our clients who were waiting to get into the Open Access Fund when it launched. Now, at this point in time, we don't have another acquisition that we have secured. We're obviously working on additional acquisitions. Whether the next one happens in the next week or 2 or 3 months' time, I couldn't tell you. So I just wanted to make sure that everybody was aware that at the moment, this is the only other acquisition that we have earmarked at the moment for issuing to the Open Access Fund. We're working on new acquisitions and hope that in incoming months we will have another. But by all means, if you have any questions about our pipeline, we can give you a little bit more information if you do have specific questions. Yeah, at this point in time, these projects have been a bit of a work in progress for a number of months. So we hope that you do have found this webinar useful, and that you're as excited about this Hawthorn East project as we are. We've been working for a long time to secure a project in this area, in fact a couple of years to secure a project in this area for our investors, and it's great to obviously have secured one, especially one where we've got a really interesting design, and we think obviously our project team is top-notch, and the market is definitely showing us from competitors that that there's demand there and that projects are being taken up well. So we're looking forward to hopefully seeing you invest in the project and to delivering a great outcome for you over the next couple of years as we deliver the Hawthorn East project. Thanks.